Hey everyone, welcome back to Corporate Decoder, the place where we dissect the numbers that move the world. And today we are diving into Jack Henry and Associates' latest quarterly report, where it looks like they are managing their earnings like a seasoned pro. Maybe a bit too much, we will see. So Jack Henry and Associates Incorporated, a company that provides technology solutions for banks and credit unions, just dropped their quarterly report, and we are here to decode what it all means. They're telling us about their financial health and how they are performing. It is a look at their business for the 3 months ending the 30th of September 25. Right now, they have over 72 million shares of common stock out there. That is a lot of ownership pieces. Let's jump into the numbers. Looking at their balance sheet for the 30th of September 2025, they had total assets of over $3 billion, which is pretty much the same as it was back on the 30th of June 2025. Not a huge jump, but not a drop either. Their current assets, which are things they can turn into cash relatively quickly, were about $651 million. That is down a bit from $681 million at the end of June. And on the other side, their total liabilities and equity balanced out to that same $3 billion. So financially speaking, they are holding steady at this moment. Now, let's talk about what really keeps the lights on revenue and profit. For the 3 months ending the 30th of September 2025, their total revenue was about $644 million. That is a nice bump up from $600 million in the same period last year. Their operating income, which is the money they make from their core business operations before considering things like interest and taxes, was $184 million. That is a significant jump from $151 million a year ago. This is a great sign they are becoming more efficient. And after everything, their net income, the bottom line, was $143 million. That is up from $119 million last year. This translates to about $1.97 per S-share on a diluted basis, which is up from $1.63 last year. Shareholder value is clearly increasing here. Looking at how the owner's stake changed, retained earnings grew nicely from $3.37 billion to $3.47 billion. This means they are holding on to more of their profits to reinvest or use for future growth. However, their treasury stock, which is basically shares they bought back, also increased quite a bit in cost from $1.89 billion to $1.95 billion. This could mean they are returning capital to shareholders through buybacks, which is often seen as a positive sign. Now, let's check their cash flow. The money coming in from their daily operations was $120 million for this quarter. That is up from about $116 million last year. So they are generating more cash from their core business. But when we look at investing activities, which is how they spend money on long-term assets, it looks like they spent a large amount, about $98 million. This includes spending over $42 million on an acquisition, which we will talk about later, and over $48 million on developing software. They are definitely investing for the future. On the financing side, where they deal with debt and equity, they used about $87 million. This included buying back over $62 million in treasury stock and paying out dividends of over $42 million. They also borrowed $20 million on their credit lines. So they are actively managing their capital structure. Let's dig into some of the important details. For their allowance for credit losses, it seems like they are managing bad debts well. The provision for expected credit losses was $480,000 for both periods, and write-offs were actually lower this year at $335,000 compared to $629,000. This indicates lower defaults from their clients. They have some assets being held for sale, totaling over $11 million. This includes a facility and an aircraft. They expect to make some gains on these sales, which will boost their income. They have about $25 million in non-current investments. These are recorded at cost, and so far, there is no indication of any impairment, meaning their value hasn't dropped significantly. The company has a share repurchase program, and at the end of September, they had about 31.9 million shares in treasury stock, costing nearly $2 billion. This is a significant amount of capital dedicated to buying back their own shares. They've adopted some new accounting rules, like those improving segment reporting disclosures. They are also looking at new rules for income tax disclosures and how they report certain expenses. This shows they are staying current with financial reporting standards. Let's look at how they break down their revenue. For the 3 months ending the 30th of September 2025, their private and public cloud revenue was almost $196 million, and processing revenue was over $267 million. This split shows a significant portion of their business comes from processing transactions and providing cloud services. Their deferred revenue, which is money received for services not yet delivered, was about $245 million that is current, and another $75 million that is non-current. This indicates a strong pipeline of future revenue. Looking ahead, they have almost $8 billion in future revenue expected from contracts that are not yet fully completed. They expect to recognize about 23% of that in the next year. That is a substantial amount of guaranteed future income. Scroll capitalized costs to obtain contracts with clients once from Scroll. They also have significant capitalized costs to obtain and fulfill contracts, totaling over $267 million for obtaining and over $287 million for fulfilling contracts. They amortize these costs over time. When it comes to fair value measurements, most of their financial assets and liabilities are valued using observable inputs. For things like certificates of deposit, they are mostly using level 2 inputs, which means they are based on quoted prices for similar assets. For credit facilities, they are valued at $20 million, also using level 2 inputs. They have operating lease liabilities of about $48 million, with almost $9 million due in the short term. These are for things like office space and data centers. They are not significant enough to cause major concern. They have a 5-year credit agreement allowing up to $600 million in borrowings, with an option to increase it to $1 billion. Currently, they have $20 million outstanding on this credit facility. This shows they have access to significant liquidity if needed. Their effective tax rate was 24.3% for this quarter, slightly up from 24.0% last year. They also mentioned a new bill called the One Big Beautiful Bill Act, which might reduce their cash tax payments. They recorded about $6.3 million in stock-based compensation costs this quarter. This is a common way companies reward their employees. They also use restricted stock units and performance units with complex payout structures based on financial performance and market conditions. The diluted earnings per share were $1.97, a nice increase from $1.63 last year, reflecting their improved profitability. Here is a big one. On the 30th of September 2025, they acquired Victor Technologies Incorporated for over $42 million in cash. This acquisition is all about expanding their capabilities in the payments market, specifically in payments as service. Victor is a cloud native company focused on embedded payments. The acquisition resulted in over $21 million in goodwill. This is essentially the premium paid over the fair value of the net assets acquired, reflecting expected future benefits like growth and synergies. They also picked up identifiable intangible assets like customer relationships, computer software, and other intangibles worth about $20 million. These are being amortized over 10 years. Now, let's look at how they break down their business. They have 4 main segments: core, payments, complementary, and corporate and other. The core segment handles data processing for banks and credit unions. Payments offers secure payment processing services. Complementary provides additional software and services. Corporate and other includes hardware and other miscellaneous items. In the third quarter of 2025, the core segment brought in over $195 million in revenue, payments over $230 million, and complementary over $194 million. Corporate and other added about $24 million. The income from these segments before corporate overhead shows core contributed over $122 million, payments over $112 million, and complementary over $121 million. Corporate and other had a segment loss of about $60 million. This shows the core business operations are generally profitable. Moving into management's discussion, they highlight a 7.3% increase in total revenue year over year, reaching over $644 million. A big driver was organic growth in their private and public cloud services, card processing, and payment solutions like Zelle and Fedno. Operating expenses were up 2.4%, mainly due to higher direct costs, increased expenses for their Connect conference, and more personnel costs, though offset by lower benefits. Despite the rise in expenses, operating income saw a strong 21.7% increase, showing solid profit growth. Let's look at the revenue breakdown again. Services and support made up 58% of total revenue, growing 5.7% year on year. This includes their popular private and public cloud offerings. Processing revenue, which includes card and payment transactions, was 42% of total revenue and grew a strong 9.7%. This segment is benefiting from increased users and new payment products. Cost of revenue increased by 1.5%. This means the cost to deliver their services is growing slower than their revenue, which is a good sign for profitability. Selling, general, and administrative expenses were up 9.4%. This increase is linked to higher costs for their user events, professional services, and employee headcount. Interest income decreased by 14.5%, and interest expense dropped by a significant 68.6%. This is likely due to lower debt levels and balances in interest earning accounts. Overall, net income grew by 20.8%, showing a healthy increase in profitability. Diluted earnings per S-share also rose by 21.1%. Within their segments, the core business revenue grew slightly by 0.5%, while costs decreased by 9.6%. This indicates improved efficiency in their core processing operations. The payment segment saw robust revenue growth of 9.0%, with costs rising 5.0%. This segment is clearly a growth engine for the company. The complementary segment, which offers additional software and services, also performed well, with revenue up 10.2% and costs up 7.6%. The corporate and other segment, which includes hardware and other products, saw a significant 31.6% revenue increase, largely due to their Connect conference. Costs here also increased by 2.7%. Regarding liquidity, their cash and cash equivalents decreased to $36 million from $101 million. This is mainly because they invested heavily in the Victor acquisition and software development. However, their operating cash flow remains strong at $120 million, up from $116 million last year. This suggests their core business is generating enough cash to fund their investments. They expect capital expenditures for the year to be between $80 and $90 million. This is being funded by credit facilities and operating cash flow. For market risks, they are mainly exposed to credit risk from clients and interest rate risk. They don't use derivatives. A 1% increase in borrowing rates would only add about $200,000 to their annual interest expense, which is quite manageable given their scale. Their management, including the CEO and CFO, has concluded that their internal controls and procedures are effective. They have not identified any material changes that would affect their internal controls over financial reporting during this quarter. Looking at share repurchases, in the third quarter of 2025, they bought back about 389,000 shares, spending an average of almost $160. Per S-share, they still have authorization to repurchase over 3 million additional shares. This shows a continued commitment to returning value to shareholders. Now, for my take on all this, Jack Henry & Associates Incorporated is showing a company that is performing well in its core business. Revenue growth is steady, and importantly, operating income is growing faster than revenue, meaning they are becoming more efficient. The acquisition of Victor Technologies Incorporated is a strategic move to bolster their payments business, which is clearly a growth area for them. Their strong operating cash flow provides a solid foundation, even with heavy investment in acquisitions and development. The buyback program and steady profit growth suggest they are confident in their future. One thing to watch is the growing treasury stock, which, while often positive, does tie up a significant amount of capital. The risks seem relatively contained, with manageable interest rate exposure and a strong credit risk profile for their clients. Overall, Jack Henry seems to be on a solid path, focused on growing its key segments, especially payments, and efficiently managing its operations. Alright, that is our breakdown of Jack Henry & Associates' latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord community linked in the description below for more discussions. Thanks for watching. See you next time.